How we doing, people? Today we're talking about guarantor mortgages, or as they are more commonly known as, joint borrower sole proprietor. What is this and how does it work? Well, if you're not familiar with how the guarantor process works, in the old days what you used to do is have an individual, typically a family member, sign a document to basically say that if you cannot afford the mortgage, then this person would step up and do it for you. It's used universally in so many different financial situations: renting, car finance, or essentially any other type of finance that you have in place. In this day and age, when it comes to the property side of things, as I said, it reverts to a concept called joint borrower sole proprietor. So what does this mean exactly for you? Well, firstly, in order for this person to be your joint borrower sole proprietor, this person would have to go through a vigorous underwriting process, much like you would as if they were also buying the property. Their name would not be attached to the title deeds of the property, so they will not own the property in any capacity whatsoever, but their names will be on the mortgage deeds, which means they are jointly and severally liable for any payments of that mortgage should you not stump up the cash. Now, the crucial thing here is the age of the person that gets involved of being a joint borrower. If you look at a parent and your parent is somewhere north of, let's say, 50, 55, you're not going to have as much of a maximum term as you want to. If you're a person who is in their 20s or in their 30s buying a property, in most cases, if you can afford the property on your own, you're going to be looking at a mortgage somewhere in the region to 30 to 35 years, maybe even 40 years if you want to keep the cost as low as possible. If you are getting a person involved in this joint borrower setup, it's going to be based on the eldest individual, which means that if that person is, let's say, 60 years of age and you're trying to buy a property as a 30-year-old, you're not going to get the 30-year term that you want, or certainly 35 or even 40 years. If anything, you might be restricted to 25 years or even 20 years, which will make the per month cost a lot more expensive when going down this route. Most of them will put you on a 5-year fixed product, and there are people that remortgage sooner if it means that they can qualify for a cheaper rate. The concept that we use is based on the idea that you do it temporarily for a period of time and be in a position to be able to remortgage the property yourself and take said person off of it so that they can go and live their lives, because it does hinder or can implicate their financial choices moving forward. If a family member, let's say a parent, decides to jump on this mortgage with you and they ever decide to go and move property themselves, they're not going to be able to be assessed properly if they require a mortgage moving forward. It may also hinder their opportunity to get a car on finance if they want, get a credit card, an overdraft, or a loan, anything. So any person who gets involved in this sort of setup needs to be 100% aware of the things that could go wrong should they choose to be your joint borrower. If that person is of a particular age, let's say they are north of 60 and they're in a position where they are not far off retirement age, the lenders who will consider this joint borrower setup with that type of aged individual will be looked on not only with their earned income, but they will also look at their pension income as well. What the lenders are looking for is the annual equivalent of their pension income. They may also consider the full pot of what that pension is. It could be multiple pensions that are involved. You can have a state pension and multiple private ones, but they're going to look at the pension income as part of the affordability, because this mortgage is going to surpass their retirement age, and they have to consider that this person that you're bringing on board as part of this purchase is going to be retired by the time you get to remortgaging them off. If you are buying a property as a first-time buyer and you use the concept of a joint borrower sole proprietor, you would still qualify for first-time buyer status and exemption of stamp duty, anything up to £300,000. The only scenario in which you wouldn't qualify for that in this setup is if the person wasn't getting involved as a joint borrower sole proprietor and they were only getting involved as a joint borrower just standardly. You can go up to a maximum age of 90 in some cases. Some lenders will let you go to a maximum of 95% loan to value, which means you only need a 5% deposit. You can have up to 4 joint borrowers, sole proprietors on the mortgage as well as the 2 people who are initially buying the property. And there are a select amount of lenders out there that will consider this vastly. So there is options to consider, as well as repayment and interest only as well.